welcome to the special edition of the Global View with me, Tanvir, Gill. My guest today on the show is the Regional CEO, ASEAN and South Asia at Standard Chartered. Anna Mars joins me on one of her trips to India, and it's so great to have you on the show. Thanks very much for taking out the time.
Thanks for having me.
And like I said, this is one of your few trips that you've made in India since you took over. How is this one different?
Well, I've been coming to India for work with Standard Chartered since I joined the bank in 2012. And so I've seen what I guess I call our ups and downs. This market was quite challenging for us a few years ago. But since I've been coming in my new role, which I took over about a year ago, I've really seen tremendous progress. I'll start talking about our business first, I guess, and then we can talk about India more broadly. 2017 is the year that Standard Chartered India has returned to profit, which is very good. But almost more important than that is the franchise is growing. This market is growing, the economy is growing, and if we can at least grow with the market, then we're losing share. So the way the team has managed to both get us back to profitability and growth makes me really, really happy in terms of the progress we've made.
Anna, we'll talk about the India strategy and your own view about the Indian market and the economy in a bit. But I want for somebody who comes down from overseas, who looks at the region, who has a more global picture in mind, and deals with global problems at a close. It's very important for me to understand how are you looking at the macro environment world over. Global growth is coming back. Everybody's very optimistic about the numbers that are being revised higher time and time again, whether it's the World Bank or the IMF. They're optimistic about the recovery. How closely do you look at those numbers, and how convinced are you of the change in the pattern of growth that the world is seeing?
So Standard Chartered is about 2/3 in Asia and 1/3 in the rest of the world. And we've been in these markets for over 150 years. The bank was actually founded in India, so it feels somewhat of a home market for us. When we look at the market, we're quite positive about medium and long-term potential. You've talked about GDP growth, it's quite strong. We're seeing a real boom of infrastructure investment across the region, whether that's the obvious infrastructure, physical infrastructure, or the digital variety, where India is really leading. And so we believe long-term prospects are quite positive. This is a year, certainly 2017 and 2016 also, where we've all had to get used to sort of different sources of volatility. So whereas market volatility is a recent memory low, other kinds of volatility, whether geopolitical or other, has really come into play. And that's more difficult to predict. But in those periods, I think it's really important to return to the fundamentals. And the big fundamentals in Asia persist, young population, good long-term demographics, and in most of our markets, really committed government policy to take advantage of that for growth and improved prosperity.
But do you think world over, globally, essentially looking at the developed markets as well as emerging markets, that 10 years into the financial crisis or from the financial crisis, growth is coming back in a meaningful manner? I mean, is that what you gather when you look at the data around the region?
Look at 2017. Our economists estimate about 60% of global growth has come from Asia. And so while there's always ups and downs through a cycle, there's no doubt that differentially the growth is more here. Looking ahead, we think that's likely to continue. I think what we're seeing is a number of policy actions. Obviously, India's in the forefront of many of them, try to get the foundations quite sound to be behind long-term growth. And we believe the outlook at sort of a 6 to 7% GDP growth across Asia you're able to bank on it. We think it will happen.
Right, and what can perhaps derail that story right now? You said geopolitical risks are top of the mind. How concerned are you about what that can do for Asian economies at large and for your business per se as well? I mean, are you preparing yourself for any sort of fallout on the geopolitical front? Because there have been enough and more sound bites on the same. Or, you believe that this is just a rhetoric that's been doing the rounds for the last 18 months. So, perhaps just it's business as usual for you.
It's business as usual. These sort of geopolitical stresses are very difficult to risk manage. Whether it's the insurance industry or the banking industry, we're much more able to model less asymmetric risks. And I think that that's right. I think we have to come back to the fundamentals of strong growth. And at a bank like Standard Chartered, who's a couple of years into what really is a turnaround, We have to just get our people focused on serving our clients better, as opposed to worrying about big tail events, which are quite low probability.
When you talk about that 6.5–7% growth for Asia, do you, I mean, how much of that is really export-led? Because that's where the question mark lies. You know, we've seen Asian currencies over the last 18 months tumble because there was all that dollar trade, which was getting very strong. Competitiveness, the fall in the currencies helped in the competitiveness and in the increased contribution of exports to the overall growth. How do you foresee Asia's export potential to the rest of the world?
I think it's going to be both consumption, domestic consumption and exports. And obviously you see very different mixes by country. China's big shift towards domestic consumption is happening, and that will be a huge driver of their economic growth. They're also quite committed to exporting more, famously, so we'll stay focused on that. But there are other large Asian economies like Indonesia, which are primarily consumption-based. We definitely saw a fall in Asian currencies in the first part of the year. In many countries that has stabilized. And as I talk to finance ministers around Asia, they're really focused on both driving up domestic consumption and ensuring they have strong industries for export. That's the way to get that sort of long-term sustainable growth.
But do you believe that in due course exports from Asia would pick up?
I think it's picking up in spots. Yeah, and I think it has a bright future. Over the last 10 years, perhaps it's been driven more by differential wages in some sectors. That's clearly going through an enormous shift. We're really seeing a transformation in services, which is driven not even by short-term macro or little geopolitical stresses along the way, but by big technology trends. And that's something that we're all working through coping with. But I think in terms of the commitment behind growing exports, getting those strong economic partnerships in place, on the trade corridors where each country is sort of differentially advantaged, it's happening.
So let's talk about Standard Chartered's ASEAN and South Asia strategy. How does that fit in? Because like you said, you know, a large part of the growth story for any bank or any financial institution going forward from here is their integration with technology. What are your plans in the same, and how are you trying to position Standard Chartered ahead of the curve, if I may say so, to take advantage of the opportunity?
So I'll start by saying that banking, like all industries, is quite competitive. And over the last 10 years, it certainly hasn't become less competitive. The combination of big banks, big domestic banks making progress, and then fintech coming in, there's no doubt that we're operating in quite a competitive environment. And because of that, what I always come back to is playing to our strengths. Right? If you're in a competitive market, you have to play where you can win. And for Standard Chartered, there's a few places we believe that we really can win. One very obvious thing is what we call the network. So Standard Chartered is in around 70 markets. We're very focused on the growth markets of the world, of Asia, Africa, Middle East. And our operations in Europe and the US, what they really do is help multinational companies in those places access these growth markets. So a lot of our strategy is about winning in those trade corridors. We're the largest international bank in Africa. We're the only international bank in all 10 ASEAN markets. As I've said before, we're very proud of our India franchise. So what we try to do is connect things. So a big part of our strategic turnaround and also our technology spend is focused on building out that connectivity. One area we've spent a lot of time and investment on is something we call the ecosystem. So if you're a large multinational company in Europe and you want to expand across Asia, we help you by banking your supply chain into these markets, either your buyers or distributors. And our ability to hook that up between a US or a European multinational and medium-sized businesses or even small ones in these growth markets is quite distinctive. To invest behind it, you have to put in place better data, so big data to analyze those supply chain trends, better internal MIS to make sure you're really capturing the opportunity across the bank. And then ultimately all the kind of client-facing technology that makes a bank easier to deal with, easier to do an FX trade on, easier to manage your corporate cash. So it's kind of a bit of a deep example, but I do think given it's a competitive market, it's important to focus on where you can win, and that's a place where we always feel that we stand out.
What about the bread and butter business in lending? How is that shaping up across the region? Because 10 years since the crisis, a lot of the mess has been cleaned up. As you yourself pointed out, the India business has also turned around. I'm sure you must have faced similar challenges for some of your other businesses in the region. How have things shaped up on that front? where has lending activity picked up? Because world over, the key talking point right now is that private investment is at a multi-year low, perhaps at a decade low, and things have really not picked up despite governments pushing for accommodative monetary policy as well as fiscal policy. So what at Standard Chartered has been your experience with lending activity? I know a large part of it comes on the commercial side as well, but you're into private wealth too. So in both those segments, what's been your experience?
So I've joked in the past that lending is still a killer app in banking, and having clients who want to take money from a bank tends to not be the hardest thing that you do. The key things are obviously lending money to clients who pay you back, right? So making those right credit choices, but also again back to where you're differentiated. If we're just competing against a domestic bank for sort of a working capital facility with a mid-sized company, we'll always lose, right? There's nothing special about us. Anyone can do that. We want to focus on working with clients who are importing more, exporting more, growing more internationally, places where we really are distinctive. And in that part of the market, we see a lot of demand. I know that Indian credit offtake is something like a 60-year low, so it's a particularly slow point in the cycle.
Is the rest of the region as bad?
No, quite simply no. We're seeing good credit demand across many markets. But even here, with focusing on that international proposition, our commercial banking business over the last year has onboarded almost 2,000 new clients, which for us is a lot. So again, if you play to your strengths and you focus on where you're really differentiated.
At this juncture, given that the business has turned into profits, how are you viewing the India story from, from the point of view of all the big reforms that have happened over the course of the last 1 year? So I was, just before this interview thinking about how the world has changed with Brexit and Donald Trump being elected in the United States, and those economies going through their fair share of transition. While back home in India, over the course of the last 12 months, we've seen a slew of reforms, whether it's the bankruptcy code that you alluded to, for that matter, GST, demonetization. How exciting does India look to you in this transition as you take forward the Standard Chartered story here?
Looking back, November 2016, I actually was in Mumbai on the night that Prime Minister Modi announced demonetization. Then the next morning, I'm an American, obviously from the accent, the next morning the US election was unfolding. And it was a case study, really, in that kind of different volatility that I was speaking about. A lot of our assumptions changed over that 24 hours. I think what's been amazing about India since is the resilience of the economy in the wake of those bold changes. I remember the early forecasts about the hit to GDP growth, and while GDP growth has slowed, it's nothing like what many experts predicted at the time. So again, we're back to believing in the potential over the medium term. Some of the reforms have been painful, whether it was demonetization then or GST, but we understand them, and we think they put the economy on the right footing in the medium term.
And when you are optimistic about India, what's the kind of growth potential that you're working with? Because the number that makes the headline is 8% plus. India has a potential to grow at 8% plus. But what we're seeing right now through this phase of transition is, we might be doing about 6.5% to 7%. Is that promising enough for you still?
Whether it's 6%, 7%, or 8%, that still makes India a very large economy that's relatively outperforming. In the world of investments, you always focus on relative outperformance, and 7% GDP growth is still very strong relative to the rest of the world. People talk now about asset bubbles in other corners of the world, right? And some of them are just created by the quantum of money post-QE that has to go somewhere. When you look at where you would deploy investment relatively, for us, India still stands out. And as I said before, when looking at our regional strategy, India is one of the top 2 places that I'm investing, because I really believe in the economic potential and what our franchise can do here.
So aside of inbound and outbound transactions, what else are you focused on in India? Because again, it's a very competitive space when it comes to the financial sector, and you're competing with some of the homegrown brands out here as an international bank. So how do you break into that?
Yeah. So there are some great banks in India, no doubt, and they're also investing. I think the good news is you don't have to break into it. We've been here for a long time. We have a good branch network. We have some excellent staff. In our retail banking business, where we're also investing, we're always focused on where we can, again, compete, which for us is about more urban, affluent populations with a focus on wealth management. And there, over the last year, we're seeing some really good progress. There's a part of the client base we call priority, which is the more affluent client base. We've grown new-to-bank priority clients by a third over the last year, which is quite good. We're also investing heavily in technology, keeping up or hopefully ideally outpacing perhaps one day the technology investment we're seeing in the Indian banking sector. And now we've seen an 80% increase in the number of retail clients using our digital channels. There's more to come on that front, plenty of things landing over the next year that the team's quite excited about. But again, back to urban, affluent, where we can really stand out.
What about the strategy of going into the deeper pockets of the country? What about going rural? Because that seems to be the natural progression that a lot of other banks are making in order to grab more market share. Or is it going to be just about, this is the affluent in India are our target market, and so we will try and broaden our service offerings to them rather than, get in more clients and try to increase more market share?
Looking at banking overall, globally, it tends to grow at roughly 2 times GDP growth. And one big reason for that is what you talk about there, the unbanked, right? People who historically didn't have bank accounts, although there must be very few left in India now after demonetization. But anyway, coming online and entering the banking system. For large domestic banks who have, thousands of branches, that's clearly a big focus. And I understand from a strategic perspective why they would focus there. For Standard Chartered, we have 100 branches. That's pretty good for an international bank, but it doesn't really get us into the far corners of the Indian economy. So we're focused on, where we can win, which is more about urban centers. And on the retail side, helping affluent clients today, or people who are young professionals who are growing their wealth, succeed here probably more in the urban markets.
What's been your view about, I know the reforms that we've seen thus far, you think they're very productive, but overall the government's approach towards making India a more conducive, or giving India the kind of platform that makes the business environment more conducive for people outside setting up shop here. What do you think, or how do you rather view the government's performance so far?
I think we're making progress. When I talk to international corporates about the markets they're most interested in expanding in, India is always early on the list. It's over the last year, I think it's only increased in terms of the international reputation of India. Everybody knows it's not a super easy market to deal in, simply because there's continued regulatory complexity, there's geographic complexity in terms of a very large country with a large population. But if I compare it to other markets that we're deep in across Asia, it's as good or better, I'd say, in terms of pace of progress.
Okay, we have to talk about the banking sector, in India, and all the regulations that have taken place within the banking sector. Starting off with the bad loan mess, we are still looking at, the numbers can vary, but on an average, over $100 billion of bad debt, right? What is the way forward, do you think, for somebody who's been able to turn around the business in India and has seen this problem unfold? What is the kind of breakthrough India can get, and how do you foresee it in terms of tackling the bad loan situation?
Yeah, so a few years ago when we set out on the turnaround of the bank, we had a new CEO and a lot of change at the top. The first kind of pillar in our strategy we called secure the foundations, which I think is very sensible. That's definitely where you always have to start. For us, that was about capital, it was about operational risk and compliance, and then it was very much about credit risk. So identifying those big exposures where under all circumstances we needed to take them down and working through them was what we focused on. We've made good progress over the last 2 years. Now, looking at India, and it's no different answer than I'd give to any other of our markets. It's about focusing on the sectors that we like and the clients for whom we can be competitive. There's no doubt that in terms of Indian domestic credit, what we say sometimes in banking is the pig in the python, right? That's got to work its way through, and we're not there yet. But reforms like the Bankruptcy Code reform, it will take a while, just getting the systems in place, but it will help. And when I look, again, India versus our other markets, I think the reforms here are more structural and ultimately will get to a better outcome.
Again, it's about the investment cycle picking up in India, which can help the pickup in credit offtake, and that hasn't quite happened, despite support coming in from the RBI. Now the government is talking about extending out fiscal support as well. What do you see changing there for the cycle to actually pick up or move higher?
The twin balance sheet, I think, is what you talk about it here. The good bit and the bad bit. You could take more radical structural action. Some economies, like U.S. post-crisis, right, was quite suited to work out bankruptcy really fast. India didn't have that system going in. You've made the structural changes, and now I'm afraid when you're dealing with an asset problem like that, it simply has to work its way through. I don't know if when I talk to our economists, I don't think there are sharper, quicker solutions. It's keeping up growth at sort of a 6 to 7% level. That's good enough. And then working its way through. And it does always take time.
What perspective can you offer? Because India is in the midst of a deleveraging cycle. Companies are bringing down their debt, they're repaying debt. We have a bankruptcy code which is helping in the insolvency proceedings and the repayment cycle. What perspective can you offer on how this can resolve the problem and over what time? Because we think that this should happen soon enough, but is that the case?
I hear commentary about that maybe it'll take a couple of quarters to work through this very large twin balance sheet issue. And whenever you look at a deleveraging cycle in any economy, even ones with very mature bankruptcy codes and staffed up courts and systems that are in place, it takes years. So I
like 3-4 years.
Yeah, I think the actions are correct. You see companies taking advantage of the bankruptcy code. It would just take a while. I think for India, though, the good news is I think you have a while. You're still growing strongly. Again, 6 to 7% GDP is strong economic growth, and you're taking the right underlying actions that give you confidence that it will work out in the medium term. And I don't think there's always a temptation to look for something quicker or sharper, but that also has downsides.
But that's the anticipation the market has, that, this bad loan problem is going to clear out in 2 years, maybe 3 years' time. But you're saying keep patience, we are on the track, but it's going to take a while for it to set itself right.
I think that sort of patient capital to acknowledge that this is still one of the growth markets of the world. There's been an incredibly impressive agenda of structural reforms that the economy has weathered exceptionally well. Let's see it through. And if it takes another couple years to get that twin balance sheet problem out of the system, I think that still positions India for very strong fundamentals.
And we can still see a strong recovery in the credit cycle and credit demand coming back while we are in the midst of this deleveraging process for companies. The business confidence can still come back in to invest.
That's why I think the twin balance sheet description is quite a good one. You've got one thing that's working its way down, another bit that's healthy and looking for opportunities. And so it's always going to be a balance. And it kind of reminds me of a bank's turnaround, Here at Standard Chartered, there are things that we've been shrinking, there are things that are very actively growing, and the moment comes when the things that are growing outstrip the things that are shrinking, and you get through it.
That's a very interesting point. So you're saying somewhere in the cycle, all the companies which are reducing their bad debt would seem a very small percentage of the companies which are actually going out there and expanding.
It'll happen, but again, it probably won't happen the next quarter or two.
Couple of years.
Yeah, that's my call.
And just before we wrap up, if I were to ask you to highlight, your top 3 big ideas for the Indian business. I know you've already spelled them out, but if it was really about focused growth in this market, then what would be your top 3 strategies for India?
Having been through 2 years of a turnaround in a bank, you spend your time talking a lot about numbers, right? It's a very natural thing. And we as a management team reflected we hadn't talked enough about what really kind of gets people out of bed every morning. So very few employees get out of bed for a 10% ROE. There's usually something more than that. And what we came up with as a management team to kind of crystallize what's special about the bank, we talk about driving commerce and prosperity through our unique diversity. And what do we mean by that? It doesn't mean that, like, gender diversity, although we're sitting here talking. It means geographic diversity. That we are, due to historical reasons, now in some of the most exciting markets in the world, 70 growth countries. We're really going to win when we connect them. And so that's what I hope we do for India. There's a huge amount of interest in FDI, again, over the medium term. I hope we're in the middle of a lot of that. This cycle, in terms of the twin balance sheet, will work itself through. Indian corporates will invest in capex again, they will expand, and we want to be on the end of that. And then driving the prosperity of this economy as we see that growing middle class. And I think if we do that, I think that's quite a special thing for Standard Chartered, and hopefully play a unique role in the development of India as well.
Would that mean more trips from you to India?
I hope so. I love India. Actually, also come here on holiday a fair degree. So it's a wonderful country with tons of opportunity, which we, again, hope very much to be a part of.
Okay, great, and I hope to see you again when you're visiting India next. Thanks very much for taking out the time to speak with us.
My pleasure. Thank you.